Welcome to the Deep Dive. We're here to take that stack of sources you sent over, cut through the noise, and really get to the heart of the matter.
And today we are definitely cutting through a lot of noise. We're talking about the metaverse.
The metaverse, and I think we have to start with the elephant in the virtual room.
Oh, you have to.
Yeah.
You have to remember that moment, late 2021, Facebook says it's rebranding to Meta.
No, it was everywhere.
Exactly. And suddenly, internet searches for metaverse just shot through the roof. It peaked in early 2022, and it felt like the next big thing.
It really did. But then if you actually look at the data, the story changes fast. There's this thing called the Metaverse Index, which tracks crypto tokens in this space.
And it just collapsed.
Yeah.
I mean, it cratered right along with the rest of the crypto market.
So our mission today is to figure out what's left after that hype train crashed. What's real?
Yeah, we're going to look past all that speculation and dig into the actual foundations. What service sectors like education or healthcare actually have some promise.
And the huge tangled mess underneath it, all payments, identity, and all the regulation.
Or lack thereof.
Exactly. So just to make sure we're all on the same page, let's do a quick definition. What are we even talking about when we say metaverse?
So at its core, you're looking at persistent, shared 3D virtual worlds. Our sources all kind of agree on three key features. It has to have immersion, real-time interaction, and this is the big one, user agency. You have to be able to do things.
Okay, so with that in mind, let's talk about those wild predictions, because consultants were throwing around some staggering numbers.
Oh, they were. I mean, we saw figures like a $4.4 trillion market by 2030. That was the optimistic take.
Which is just a massive number. What did that assume?
It basically assumed that like a third of the entire digital economy would just move into the metaverse.
Okay, so that's the ambition. Now for the reality check, because the actual user numbers are, well, not that.
Not even close. Take Meta's main social platform, Horizon Worlds. At its peak, it was under 300,000 monthly users.
And it's dropped since then, right?
Yeah, reports say it's now under 200,000. And think about the hardware. The VR headsets. By the end of 2023, the total number of headsets ever sold was just under 26 million.
So it's not exactly a smartphone level market yet.
Not at all. It's still very niche. And that contrast really gets us to the core tension of the whole space.
Yeah.
The huge gap between the centralized giants and the, decentralized Web3 dream.
Okay, so let's unpack that. When we talk about the tech stack, it's not just one thing, it's layers, right?
Right. You've got the sectors on top e-commerce, education, gaming, then the software, the interface like the VR and AR gear, the infrastructure like 5G and the cloud, and then what our sources call the enablers.
And that's the really tricky stuff. Payments, identity, governance.
Exactly. And when you look at who's actually using these worlds, the numbers are completely skewed.
How so?
Well, you look at a centralized, maybe lower tech platform like Roblox. In the second quarter of 2023, they had 66 million daily active users.
66 million. Daily. That's a staggering number.
It's huge.
Yeah.
Now, compare that to the decentralized blockchain worlds like Decentraland or the Sandbox.
Their numbers are, what, a tiny fraction of that?
Orders of magnitude smaller. All the action, for now, is in these big centralized platforms.
So Roblox is the perfect case study then. They have this massive functioning virtual economy.
For sure. Everything runs on their currency, Robux. And creators can actually cash that out for real money through their DevX program.
And the scale of that economy is pretty mind-blowing.
It really is. In a recent quarter, we're talking $1.1 billion in revenue, and they paid out $316 million of that to creators. It's a real economy.
Okay, but here's where it gets really interesting, and our sources really highlighted this strategic shift. Roblox is changing how it pays people.
Yes. This is a huge deal. They're moving away from just rewarding creators for how much time people spend in their games.
Which you'd think would be the main metric.
Right. But it can incentivize low-effort, sticky content. Instead, they're starting to tie rewards directly to new user acquisition.
So bringing new blood into the ecosystem.
Exactly. The new model is something like a creator might earn 5 Robux for every active spender who stays in their world for 10 minutes or more.
Wow, so that directly aligns the creator's incentives with the company's goal, which is profitable growth.
It's basically a Darwinian approach to content. The stuff that brings in valuable new users is what's going to thrive. And it makes sense because their users are getting older.
Right. I saw that stat. Something like 64% are now 13 or older.
Yeah, they're moving beyond being just a kid's game. They want more mature experiences that can drive real spending.
But it's not all rosy. These centralized platforms face a ton of criticism.
A ton. The sources talk a lot about, claims of exploiting young developers, tons of scams in the world, and this whole market for limited collectibles that some people say is basically unregulated gambling for kids.
And that dark side, the potential for scams and exploitation, it's a good bridge to why this tech might actually be needed in more, let's say, legitimate sectors.
Right. Let's pivot away from gaming for a second. The metaverse concept is really well suited for the services industry, which is the fastest growing part of the economy.
So where do we see the most potential? Let's start with education.
Okay, so for education, the market estimates are pretty big. We're talking maybe $24 billion in revenue by 2030. The U.S. would be the biggest chunk of that at around $8 billion.
And what's driving that? Is it just about having a cool new toy for schools?
Not really. It's a continuation of the remote learning boom we saw post-pandemic. I mean, think about it. Zoom was downloaded over 1 billion times in 3 years. Apps like Duolingo are still growing like crazy.
So people are comfortable with online learning.
Right. And the metaverse is just the next logical step. It offers an immersive, real-time collaboration that you just can't get from a flat Zoom call.
Okay, so education is one. What else?
Healthcare. The projections here are even bigger, potentially over $50 billion in revenue by 2030.
50 billion. But what's really fascinating in the source material is how uneven that's expected to be across the globe.
It's incredibly uneven. You have countries like Switzerland or Singapore, where they think the penetration rate could hit like 7% by 2030.
Okay.
But then you have others like China and Mexico, where it might be less than 1%.
So what does that tell you? Is it just about which country is richer?
Not just that. It's more about regulatory readiness, about infrastructure, about public trust in digital health systems. The countries that are poised to do well already have strong data privacy laws and the networks to support this stuff securely.
Makes sense. So what are the actual applications? We're not talking about gimmicks. Right?
No, not at all. Think about virtual clinics. They can completely break down physical barriers. You can get a consultation with a top specialist on the other side of the world instantly.
And you avoid sitting in a waiting room, which post-COVID is a big deal.
A huge deal. It eliminates that whole infectious disease transmission risk. And then there's treatment itself.
What do you mean?
Something called virtual reality exposure therapy, or VRET. It's being used for things like phobias and anxiety disorders.
How does that work?
Well, you can safely and gradually immerse a patient in a virtual scenario that triggers their anxiety, like being on a plane or standing on a tall building. It lets them confront it in a totally controlled environment.
That's incredible, but these are really high-stakes transactions. You're not just buying a virtual hat for your avatar.
Exactly. And that brings us right to the biggest hurdle of them all, the money. The moment you're trying to transact $50 billion in healthcare services, you need a payment system that is rock solid.
Which brings us to the money maze.
It is a total maze. And what's funny is if you look at user surveys today, the reality is kind of counterintuitive.
In what way?
The most common payment methods are just normal ones. PayPal, debit cards, credit cards. They're used way more than any cryptocurrency.
That really pokes a hole in the Web3 narrative that everything needs to be on a new token.
It does. And the reason seems to be stability, or the lack of it in crypto. I mean, you can look at a centralized platform from the old days, like Second Life. They use Linden dollars. If you want to buy them, you pay a 10% fee. If you want to sell them for real cash, you pay a 5% fee.
So they control the whole system. They prevent arbitrage and keep it stable.
Exactly. It's restrictive, but it's stable. Meanwhile, you look at the Web3 tokens like MNA for Decentraland or SAND for the Sandbox.
And they're just tied to the insane volatility of the crypto market.
Totally. They crashed hard in 2022. And you can see the problem, right?
Yeah.
If you're a therapist, you don't want the payment for a session to drop 20% between when it was booked and when it was delivered.
Of course not. So this volatility is what forces the regulatory conversation. How do you even classify these assets?
That's the billion-dollar question for regulators. The SEC's main tool for this is something called the Howey test.
Which is really old, right? It comes from a Supreme Court case from the 1940s.
That's the one.
Yeah.
And it's still the main framework they use to decide if something is an investment contract, which would make it a security, and put it under their control.
So what does the test actually look for?
It's basically 4 things. 1, an investment of money. 2, in a common enterprise. 3, with an expectation of profits. And 4, this is key, the profits come from the efforts of a third party, like the developer.
So if a token is just for, say, accessing a service like a prepaid coupon, it's less likely to be a security.
Much less likely, especially if it's marketed for its utility, not as a way to get rich quick. But then you have the CFTC, which regulates commodities.
Right. And they see some virtual currencies as commodities.
And then you have NFTs, which are even weirder. They're like unique collectibles, a piece of art or virtual land. So they probably aren't securities or commodities. Unless they're packaged up as some kind of investment scheme where the issuer is promising you'll get a return on their work. It's a legal minefield.
So given all that complexity and the volatility, it seems like the future needs something else, something stable, fast, and that works across borders.
Precisely. And that's why the public sector is getting so interested. You're hearing a lot about central bank digital currencies, CBDCs, and tokenized deposits.
Basically a digital version of the dollar or the euro.
Yeah. They offer the stability of government-backed money, but with the speed and programmability you need for this new economy, it could be a much better option than relying on purely speculative private assets.
Okay, so let's pull the lens back. If we get this right, if there are stable payments and clear rules, what does a successful metaverse actually do to the global economy?
The sources point to three really fundamental shifts. The first is this blurring of what's tradable and what's non-tradable.
Meaning?
Well, think about services like healthcare or high-end consulting. They used to be stuck in one physical place, non-tradable. Now they can be delivered anywhere. That is a massive acceleration of globalization, but for the service sector.
Okay, that's one. What's the second?
That leads to much greater cross-border economic integration. Your physical location just matters less and less. It could lead to a more efficient allocation of talent globally and a huge rise in location-independent gig work.
And the third shift must be about the payments themselves.
It has to be. You suddenly have a need for a new payment infrastructure that can handle millions, maybe billions, of tiny cross-border micropayments happening in real time, securely and cheaply.
And that's something central banks are watching very, very closely.
They are, because they want to set the standards for that new global infrastructure. They don't want to leave it entirely to the private sector.
Which all leads to this huge, unavoidable public policy problem. You can't just let a few big tech companies build their own little fragmented proprietary metaverses.
No, that would be a disaster. The policy has to focus on forcing standards for interoperability. Your identity, your assets, they should be able to move with you from one platform to another.
And what about data? VR headsets can collect an insane amount of personal information.
That's maybe the scariest part. They can track your gaze, your biometric responses. It's so much more invasive than a web browser. So we desperately need strong standards for data privacy, consumer protection, and true digital ownership.
And finally, that brings us to the really existential challenge, the one that goes beyond just tech, taxation, regulation. How does any of that work in a truly borderless world?
It's the ultimate jurisdictional puzzle. The hype might have died down, but the tech is moving forward in these really high-impact areas. And its success completely depends on whether we can figure out the governance and the payment systems now, before it's too late.
So if the metaverse really does blur national boundaries and challenge our current legal structures for property and commerce, here's the question we want to leave you with. When a conflict inevitably happens in a virtual world, a contract dispute, a theft, an accident, how will anyone even begin to figure out whose laws apply in a world that's designed to exist beyond borders?
A fascinating and, frankly, an urgent problem to solve.
We'll see you next time for the next Deep Dive.